Hi there, and welcome to a new initiative from Upstream Ag Insights. My name's Shane Thomas. So, one of the things that I've done within Upstream is talked about some of these more horizontal sort of mental models, horizontally applicable frameworks and thinking processes. And one of those has came across as an ebook, and that's overviewing 40 different cognitive biases that can impact how agribusiness professionals make decisions or are influenced by individuals that are trying to help them make a decision or move them in a specific direction with their decision. And so what I want to do is create some videos around singular biases or singular mental models and bring those to life with some examples and some overviews. And so this is actually the second one. The first one was on the IKEA effect, and you can see that linked below. But today I want to talk about one called not invented here bias. And this is something that I think is really important in all industries, but specifically in agriculture, where new technology, new innovations, and new things coming to market can be pushed aside if they are not brought forth by an in crowd or by the specific team that you're constantly working with. And so we'll go through not invented here bias, what it is, who discovered it, and how. We'll go through why it needs to be managed, the problems that it can cause, an example, and then we'll talk about how to manage it. And so to kick things off, I think most agribusinesses will tell you that they value innovation. They have innovation teams, R&D budgets, innovation pipelines, all these different things. Yet many of those same companies have a long track record of passing on better or different technology or acquiring startups and not enabling them to thrive and building proprietary versions of tools that the market already offers. That pattern has the name not invented here bias. And once you see it, you start seeing it everywhere within the industry. And essentially what not invented here bias is, or sometimes you hear it called not invented here syndrome, and it's the tendency of a team, division, or company to undervalue or outright reject ideas, technologies, or solutions that originated outside of the group or the company. And so the bias isn't about whether the external idea is good, bad, or otherwise. It tends to operate regardless of the quality of the idea. The instinct is simply to favor internal work because it came from inside, because you're familiar with the people, because you feel like you're a part of a superior team or a thinking process, whatever it might be. And so you undervalue anything that comes from outside. And so it's closely related to a couple other biases that we see. So one is the endowment effect, where we overvalue what we already own, and the IKEA effect, which is one that I've covered already. But essentially, that's where we overvalue something we've built ourselves. Not invented here is specifically about the source of an idea. So if we made it, it feels credible. And if they made it, it feels suspect. So we have this sort of in-crowd thing, and this is a very big human bias. And the result is an organization that systematically underweighs outside knowledge and overweighs its own internal conclusions, R&D, thought processes, whatever it might be, even when the evidence may point in a different direction. And so the bias itself was discovered or formally documented by two individuals at MIT, Ralph Katz and Thomas Allen, in 1982. So it's been around for a while. And it was in a study that was published in R&D management. And Allen had already spent years at the Sloan School studying how engineers and scientists actually communicate inside research labs. And then Katz and Allen looked at 50 R&D project groups inside a large industrial laboratory and tracked their performance against how long the teams had been together and how much they communicated with people outside the group. And the pattern became very clear when they looked at it. The group performance climbed for about a first year and a half, but then plateaued. And then it started to decline, specifically as you got out even further to the 5-year mark. And so the mechanism that they identified wasn't fatigue or skill loss within these groups. It was purely the communication aspect of things. And as teams stayed together longer, they talked to outsiders less, meaning external groups from their team or external companies or external universities. And they came to believe they held a monopoly on the relevant knowledge in their field. And that means ideas were dismissed before they were even evaluated thoughtfully and with a very objective point of view. And so what Katz and Allen called that pattern was not invented here bias or not invented here syndrome. And it was one of the first empirical demonstrations that organizational tenure itself, without any change in talent or resources, could actually degrade innovation performance within a group or within an entity. And so it matters, and we need to manage this because it operates in this sort of gap between what a company says about innovation and what it actually does. And meaning leadership will commit to being open to new ideas or collaborating or doing open research or whatever it might be. And the organizational chart may have some external partnerships, or the R&D budget may include some licensing, but then a specific external technology shows up and the response is technical objections that sound sort of rigorous but trace back to the cultural or internal resistance. And the cost feels invisible in the short term or not relevant in the short term, but it's pretty significant in the long term, because competitors who are more comfortable in looking at external sources, bringing people in, collaborating, partnering, investing, licensing, or acquiring will get ahead or have the potential to be ahead. And so markets compress around technologies you decided to rebuild yourself instead of adopt. And so acquired companies underperform because the acquiring organization unconsciously discounts what made them valuable in the first place, because you bring this external company in and then they're brought in because they have this great idea, technology, product, whatever it might be. But the internal people that might be leaders in that specific segment, they're trusted by the commercial team, they're trusted by other groups on the team. They discount it, or they don't buy in, or they had been working on something similar and thought that their approach was superior. And so all of a sudden you have this sort of clash, but you also have this lack of trust and lack of incentive to really move forward with that technology. And that means both the technology that was already there, or the product that was already there, and what gets brought in don't move forward, or do not move forward in a way that can actually bring commercially, or call it business, positive outcomes. And in a sector like agriculture, where development cycles are measured in years and capital deployed runs into the hundreds of millions on products, a 3-year delay that could have been caused by Noddam-Deer syndrome can be the difference between leading in a specific category or chasing it. Or maybe it's the data feedback loop that they're missing out on. And so there's a bunch of different problems that can come in, but all of a sudden you're behind, and you want to be able to move things forward when it comes down to investing in technology and using new technology. And so we'll get into one specific sort of example. If we consider, let's just think about a major crop protection company engaging with biological products over the last 2 decades. So by the mid 2000s, a wave of smaller companies were building serious science around microbials, seed treatments, biostimulants, biological fungicides, insecticides, all the way across. This has been more than 2 decades, quite frankly. And the trajectory has seemed pretty clear that there's going to continue to be interest in that. There's, again, some, we won't get into it today. There's some other external factors and things beyond the biological technology and stuff that help drive that on the consumer side and environmental side. But fundamentally, there's been some movements. But the response from most major players, at least up until the last 4 or 5 years, was pretty dismal. They dismissed the potential of a lot of the technology. And so internal R&D leadership had departments built around decades of synthetic chemistry expertise. They treated biologicals as a softer science with inconsistent field performance instead of looking at how do we make this more consistent. The objections were from, again, outcome variability, shelf stability, unclear regulatory pathways, and those concerns are all legitimate. They were also a convenient frame for the cultural reality internally within these companies. The people doing biological discovery weren't necessarily part of the in-house club, the call it leaders within the groups. Most individuals that are leading R&D at a crop protection company or a seed company, they have strong science backgrounds or technical backgrounds in synthetic chemistry or in the actual trait development or genetics or whatever it might be. And so the chemistry or the biologicals were not the same sort of core competency that they had. And so I think that's really interesting to look at. And really the result has been, a multi-year stretch where major organizations largely watched the category form around them. And you had companies like Valagro and Stoller and Marone Bio and all these different groups build brands, build out distribution and IP in the spaces where the majors had every advantage on paper, but no internal urgency to do so. And that's not a fault. Again, there's a lot of conflicting incentives within organizations. It's not to say anything poor about these large groups. That's just these biases and incentive structures tend to move people in that direction. And so when the major companies finally did move, they made acquisitions or partnerships at premium valuation. So you had Syngenta acquiring Valagro in 2020 at something like $600 and some million. You had Corteva acquiring Stoller and Symborg in 2022, and Stoller was acquired for about 1.2 billion. FMC buying BioPhero for over 200 million, and you had Bayer collaborating with Ginkgo Bioworks from a collaboration perspective. And so each transaction was a public concession that in-house R&D had not actually produced what maybe they had intended or what they thought they could produce, and there was already teams externally that could be brought in to fast track the biological initiatives. And so these patterns sort of compound even once a deal closes as well, where you have internally these acquired biological teams report into traditional crop protection segments within the business, or they get measured against timelines and gross margins of synthetic chemistry or whatever it might be, or they lose development latitude that maybe let them develop that novel IP in the first place. And so that same instinct that delayed the original investment now kind of shapes the entire asset utilization internally, which can be negative. And again, I'm not saying this necessarily happens. This is just what could happen within the likes of Corteva or the likes of Syngenta with these standalone biological assets being brought in. And so the ultimate cost is not only the acquisition premiums, but it's also the lost decade or whatever it might be of internal investment that could have produced better biological pipelines, or could have been brought to market more effectively in a leadership position if there was not so much of this potential bias of, hey, you know what, they're outside, we're inside, we're in the in club, they're not. And so I think that's just one example of where that could show up, or non-invented here bias can show up within agribusiness. And so, I think the question then becomes, well, how do you manage it? Now, I'm not going to sit here and claim I have all the answers around that, but if you look at some of the research specifically from the individuals that found the bias, so Katz and Allen, there's a couple, call it practical levers. And so one is, they say, to rotate people across teams and functions, so no group sort of calcifies as in group or out group sort of thing. The other way is to build external scanning teams into a formal innovation process with explicit criteria for evaluating outside technology. Again, imperfect, but you do see a lot of that within organizations today, whether it's actual venture capital groups within these large companies, or it's somebody with the actual focus of looking at external collaborations. I know Bayer has individuals like that, and I'm sure others do as well. And so the other thing they say is to measure and reward what the research community calls knowledge imports. So meaning successful integration of external ideas with the same weight that you give internal innovations. That's, again, hard to do, easy to say. But when an acquisition closes, protect the acquired team's autonomy long enough for you to actually learn what they do differently before you fold them into the mothership, so to speak. And so those are some of the things that Katz and Allen talk about to be able to really try to overcome the bias as much as possible. And fundamentally, it's a culture issue. Most organizations reward people for what they built, and very few reward people for what they bring in. And until you change that and make it more common or acceptable, not invented here bias will keep quietly costing years of progress and dollars and fundamentally the future product innovation if it's not managed thoughtfully. And again, there's tons of different biases to be managing all the time for senior leaders within the industry, but I think a lot of it just comes down to, how can you acknowledge or see where it may come in, and how can you change that incentive structure accordingly, or how can you set the expectations, how can you shape the culture accordingly to make for better outcomes. And so I'll leave it there on the not invented here bias, but if you're interested in more like this, I'm going to be recording many more videos here in the coming weeks and months. There's also the ability to go to www.upstream.ag, and you can find the cognitive biases ebook that's available. You can go through about 40 of them. I think there's 200 plus cognitive biases out there. And in the ebook, I talk about some of the ways to be able to leverage the understanding of these biases. And one is around making better decisions, but there's the other dynamic of how do you better influence people as well too. And so that's kind of the key focus there. And so with that, I appreciate you listening, and I hope you have a great rest of your week.